everybody. I'm Panos Katsambas. I'm a partner with ReedSmith in London, and I couldn't be happier to be here in person with suits and tie and everything, and be back on the road and seeing a lot of familiar faces. Our panel is going to talk about consolidation in the shipping market, M&A and consolidation, a topic that we've routinely touched over past conferences here at Capital Link, and has been discussed greatly in light of private equity investment in shipping, in light of some transactions that we have seen in the past few years. But I think for the most part, most would agree that it still remains an elusive target for the most part. So with me today we have Nitin Mehta, CFO and Head of Strategy at GMS and CEO of Lila Global, Jeffrey Pribor, CFO at International Seaways, Michael Kirk with RMK Finance, and Erol Sarikaya with Tufton Oceani. And we'll be able to hear perspectives from different participants, let's say, in the market. But as we get started, I'd like, as an initial commentary from our panelists, what do they think that the biggest roadblock is currently for a greater consolidation? Jeff?
Well, I think some of the roadblocks that were there are less roadblocky than they were. When we traditionally spoke about consolidation and shipping in the past, we thought social issues were the biggest roadblock, often how to work out those details of board and management, things like that. I think that there's evidence that that's less of a concern, and there's more of a path towards getting deals complete. I know your intro said we're still frustrated by the lack of consolidation. I beg to differ a little bit. We completed two big consolidation moves in 2021. One was a stock merger with Diamond S, and the other was more prosaic, you'd say, acquisition of three, but equally important in a lot of ways, three dual-fuel new-build ships that will deliver in Q1 on long-term contracts. So we were able to overcome any roadblocks and get two really solid deals done, and having to talk more about it. But I think that the same old roadblocks are kind of there, but I think there's an increasing tendency or trend to be able to work through it, and we will see more and more consolidation as time goes on.
Yeah, no, thank you for that, and certainly we'll be coming back to talk a little bit more about your transactions. Michael, from the advisory perspective, how do you view the landscape and opportunities?
Yeah, I think part of the roadblocks.
I think.
Why not? Hello? Yeah, there we go. I think part of the roadblocks have been kind of the traditional reasons for M&A is the company's inexpensive. I think in shipping it's challenging to buy a company very cheap because they always have the alternative of selling assets. Another good reason for M&A is synergies, whether on the revenue side or the cost side. I think with shipping, even if you do M&A, it's hard to get an enormous amount of market share. Cost synergies have been somewhat elusive, but I think what we've seen is M&A driven by investors looking for liquidity and creating some size and scale, and I think that's really panned out. If you look at the larger companies, they tend to have much better liquidity, which is expected, but they also tend to trade at much better price than NAVs. So I think we're seeing sort of the M&A be successful, and I think we'll see more of it going forward.
Great, thank you. Erol, your perspective?
Yeah, I think the one other element I'd add with from private equity's mindset is, first and foremost, we're there to, when we make a shipping investment, we're there to invest in a thesis. The management team that we might be backing at any one point in time is sort of second to that first calling, and so I think that's why naturally, for over the years, people have looked to private equity firms as part of their consolidation play to attack those fleets, for lack of a better word. I think the biggest roadblock, Jeff hit on it, Mike hit on it, and you've seen it begin to unglue. Shipping companies, by and large part, have traded at a material discount to NAV. So it's just bad math. Why would you take stock in a public shipping company and mark your book down when you could sell steel at NAV and distribute cash when you think the thesis is ultimately played out? So I think as public markets are more receptive, certainly in this warm, healthier climate, you're naturally beginning to see more deals happen.
So would you approach from an investor standpoint as you underwrite new transactions and so forth, and mapping out your exit opportunities in a future timeline? You suggest that, I guess, selling the assets or monetizing the assets per se is a more optimal option than trying to do something at a corporate level as in other deals.
Well, the big goal would be if you can build a true enterprise and that can trade at a premium to NAV, well then you're value accretive through that approach. The problem has been the public markets really haven't been receptive for shipping. Barriers are low. There's many homogeneous fleets which ultimately have their own impediments we've seen because it's hard to survive the cycles, and so they trade at a discount from that perspective. So I think, again, it comes back to that public mark perspective. The other element that I think is working in M&A's favor, a large part of the private equity boom, or that thrust of capital invested, came around 2013, 2014. We're now 8-9 years into those investments. That's a natural sort of ending framework from a investment fund's perspective, where it reaches that end period where they look to an exit one way or another. So I think you're much more receptive because time, which was your friend for 2016 through 2020, is sort of against you now.
Nitin, your perspective from the private sort of ownership side of things?
Well, as private owners, we are always looking for opportunities. We are counter-cyclical by our thought process. So right now is not the time when we are looking for a lot of opportunities to buy. We are expanding. We have, in fact, last 1 year we have gone from 12 vessels to 23 vessels. Many of them are tankers, but that space is also getting limited now. So yes, there is definitely a thought process where we are looking for opportunities, but not many are selling at the level we want them to sell at. So I think it's a bit of a time where we all have to wait. I think we have to wait for the next phase for the market to turn around again and see what opportunities present themselves. But we are definitely in there to pick up few if there are opportunities. So anybody who wants to sell or something, we are definitely looking for options.
Okay, well, maybe we can broker a deal alongside the panel discussion. Jeff, coming back to you and taking Erol's points, I guess is getting bigger and growing further potentially a solution to correcting the discount to NAV of the trading of publicly listed shipping companies? Is size and liquidity the reason for the discount, and correcting that enable more opportunities?
Well, I think there's more than one factor behind valuation, for sure, but there's no question in our mind that scale is beneficial. There are cost synergies. That's not the major driving force in shipping M&A, but there are some cost synergies, and that's helpful. So your profit margin can go up, or it's most easy to see it in terms of G&A per day, for example, going down, per G&A per vessel per day. In terms of size in the capital markets, yeah, I think the way you have to look at it, the way public company managements have to look at their position is we're in a competition for capital. It's tough to get people to invest in shipping, and tougher still to get them to come to your company if they haven't been invested in it before, and it's been trading at a certain value, and you think you should be re-rated. Well, that's a tough mountain to climb, and we've been working on it for 5.5 years since we were spun off. And I do think that was one of the I know that was one of the factors behind our decision to double the size of our company with the stock merger with INSW last year. And I would say now, a year later, looking back, that it has been helpful. The market, we knew that it would be a good deal, and I'm not here to talk our book. So let's try to draw conclusions that might be helpful going forward. So what did we learn? We thought it would be, we knew it would be a good deal. We just didn't know how long it would take. We didn't know the market would stay down that long. But to your specific point about size of the capital markets, we're hoping for greater liquidity in the stock. And it didn't happen right away, but a year later, we're now trading an average of like 600,000 shares a day, which is about between $15 and $20 million. We traded $40 million of stock the other day. That's still small compared to the amount of Microsoft or Apple or whatever, but for shipping, that's getting into an area where you can attract the long-only investors that with bigger funds that need that kind of liquidity to invest. So yes, I think scale. We have proven out that one of the benefits of consolidation for a public company can be greater liquidity and better valuation. To finish the thought, we're probably trading at close to 0.9 times NAV, so we're approaching that goal of being at least an NAV, and that's higher than we were a year ago. So.
Michael, would the trading share price of smaller listed companies can be viewed as an opportunity to create greater consolidation or transactions, or see investors trying to launch tender offers, etc., take advantage of that discount to NAV, or are trades like that difficult to materialize?
Yeah, I think they are difficult because a lot of the smaller owners, have a very large shareholder that is often management, and again, they probably don't want to sell, and if their stock is cheap, they always can say to the board, hey, why would we sell for below NAV? I think one of the things that over time is going to become potentially a little bit more compelling is you're seeing the larger companies not only trade at better equity valuations, which is part of their cost of capital, but also able to access debt at much cheaper levels, and that starts to become material when, as Jeff said, shipping is ultimately a cost of capital business. And so if you can improve on your debt margins and you can issue equity at a little better valuation over time, all else being equal, you're going to kind of be the surviving entity, you're going to be the entity that's able to grow. And so I think over time we'll see that, but there's most shipping companies are private, so to that end there's a lot of room for those. I think there's still room for some of the smaller public companies, and I think M&A will become, most of what's happened has been investor driven, so I think without that kind of emphasis it is challenging.
Erol, in terms of the smaller private companies, how do you approach investment opportunities around them and at the corporate level as opposed to buying the assets? And is there room to drive consolidation through the private ownership model?
Well, I think Jeff laid out very good points about size is better, really from the liquidity standpoint, and I think that was really well said. I'd say it slightly differently for us and Tufton, and it's a great question because it's very core to what we look at SHIP, our publicly listed vehicle on the London Stock Exchange. Asset diversification is another way. We see so many homogeneous fleets, and core to what SHIP is doing is being able to have that broad diversification across various asset classes. We were long containers, had very large exposure, which we ultimately sold at the beginning of this year. We increased our exposure to dry bulk, the geared dry bulkers in late 2020, very good timing again. Now we're increasing exposure to product tankers, and so having that ability to play various segments, I don't think you'd find many public owners being able to sort of just sit on cash, even though it might be the right time to sell in their respective market when they otherwise have all of the same asset class. And so we've found asset diversification to be very critical to our success. I don't want to just give a plug here, but Tufton, the ship has had a 17% unlevered, largely unlevered IRR since its inception in 2017. So I think that asset diversification as a means to achieve scale, to a lot of Jeff's points, around liquidity is very well stated.
So you're competing for capital as well as a public company, right? So you've got investors to please. What you're saying, my takeaway from your comments is that, Erol, is that your diversification across broad diversification, containers, tankers, is a plus for your investors.
Yeah, I think we've gone through 15 years where credit funds, large institutions have dominated the conversation. and those institutions wanted to call individual markets. The downside of that is we've had homogeneous fleets, many of them have been levered, and so when you have homogeneous fleets levered, so you've added operating leverage to an already highly cyclical asset class, they just don't survive the down cycle in their respective markets. And so having that broad diversification, having that little to no leverage, I think positions us quite well. Really, shipping's about when do you buy and when do you sell in any particular
Well,
asset.
that's for sure, and I'm sorry.
By no means,
You encouraged me to break in, and I
it's
can't help
the-
myself.
The best part of the.
Yeah,
the
so,
fund.
but I think that's informational for our audience, which is this diversification is becoming better accepted. I don't think that was always the case. Sitting and talking in Capital Link 10 years ago might not have been the mantra. We found that, I'll put air quotes around it, diversification between crude and product tankers. Clearly, that's real diversification. It's not like containers or bulk in the same portfolio, but that used to be not favored, let's say, by some equity investors. We were, as our predecessor, but certainly since we were spun off, Seaways has been diversified, but we were probably a little more heavily crude. Now the Diamond S acquisition came with 50 MR tankers. We sold some, but we still have 40 of them basically today. And we didn't know that they would be leading the tanker market upwards because of geopolitical factors like what's going on, displacement of patterns of trade in Europe because of Ukraine. Of course we didn't know that was coming, but we knew that scale was important, as I previously said, and we believed that diversification was definitely not bad and probably good, even for an equity as creditors always like diversification generally, and I think that's been proven out. So I think that's a lesson for other ship owners is that diversification, at least modern diversification, can be a very positive investment message.
And if I could just add the one comment, I think that in and of itself, we go through cycles, right? Like, if you were building up bigger companies, the initial phase of that was bigger is better, and so you had a race to being the first ship owner to have 100 ships within the product tanker space. The correlation, whether you're an LR2, is all the way down, very high. And so, your points around what you've looked to do and achieved, is very well said, and we see it the same way. Just more broadly, being able to go outside of any asset class.
So, Mike, that means you can pitch diversification in M&A. So.
I was about to, a great segue, because I was about to ask Michael if you think that, kind of asset diversification is a way to potentially consolidate smaller owners and create something different.
Yeah, so I think there's two things. I think crude and products make sense together. I mean, you're dealing with largely the same counterparties, similar assets. Yes, it's diversification, and it worked out very well this year in the case of INSW. I think, adding container or dry bulk in the U.S., if I'm an investor, I might say, hey, this is the best dry bulk company, I'm going to buy this company. This is the best container company, I'm going to buy this company. This is the best crude. And as long as the leverage is, reasonable, or maybe at a certain time where as an investor I want to buy a highly levered company, I can kind of make that decision. And it's actually interesting, Erol, I'm wondering, with Tufton being in the UK and there's not a plethora of shipping companies to choose from, it actually probably is a big advantage that you're diversified, so people can get the shipping risk without having the extreme ups and downs that you can see within a specific sector.
Certainly, and I think the most important issue that's to really dive into is we're targeting investors who favor yield certainty, yield predictability, right? And so not necessarily a trade for 3 or 6 months where we think dry bulk is going to be hot and I want to have the biggest fleet with the most leverage. Rather, I want to have a proper steward of capital who's going to survive through cycles over the next 5-10 years, and I can park my capital in a very good public space. And I think in order to do that, you have to have the right setup, a fixed dividend, a low unlevered fleet, broad diversification. And I think when you combine those three very structured elements, you have a unique value proposition. Now it's about growing that.
Nitin, if I may ask from your perspective, how do you, the earlier panel was talking about other trends in the current market, environmental regulation, ESG, sanctions. Are these sort of external factors impacting decision making on company size and potentially look to have a bigger setup to deal with operational issues or regulatory concerns?
Yeah, Of course, all the environmental issues. The sanctions is easy, like someone mentioned, is binary is yes or no, so that's easy. The compliance on the environmental, the ESG part is a tricky one. We are well diversified also. We have more than 20 bulkers and 11 tankers and a passenger vessel as well. So we are always mindful of the fact that what are we doing next, because with next year CII, EXI, etc. coming up. So I think the focus would also change to technology. So we are looking at various options how we can bring down, because we do have a relatively older fleet, average age is about 12 years. So we are mindful that we have to do something quickly to make them viable, to keep them viable. So I think next consolidation may get triggered by the cost of making these vessels environment friendly or ESG compliant. So I've been looking at technologies. I've seen some presentations myself. I'm actively involved with the providers. It can go as high as $5 to $7 million a ship. So that would trigger a lot of smaller ship owners to look for partners because banks may not be ready at the right time. Michael here is, of course, Poseidon principle, etc. We'll have to adjust to that as well. Do these technologies actually work? Because a lot of technology in shipping have been nice to have, so to speak. Talk about paints, talk about many things which they talk about increasing efficiency. But the truth is, these kind of things have to be tested, and this directly involved with the engine could be relatively easy to figure out. So we are, the short answer is because we are older fleet, we are mindful, more mindful than everybody else, looking at technological options which we have currently. But I'm fairly confident from what I'm hearing and seeing, by next year we will have answers to many of these questions. Once we have the correct calculation as per CII, when we start noticing from 1st of January, we start calculating them. I'm not very worried, honestly, that what will exactly happen, because eventually, because make no mistake, letting a vessel go is not an option, because letting a vessel go and you want to make again, because the transportation has to happen, because 90% of the goods are use shipping, right? So we cannot just let the ships go. So we have to make them viable. To make a new ship, if you want a ship with a 20,000 ton steel, you are talking about burning 15 million tons of coal. And I'm not even adding what a queen does and everything else does to the environment. So we all have to sit together, figure out a way, and then approve certain technologies which come on board, reduce and become ESG compliant. Banks have to support, because a lot of small ship owners, although making money right now, are repaying debt. They could be, if I was them, I would build a war chest, because this would be a requirement. They have newer fleet, then yes, suppose for next 2-3 years they're not worried, but 2030 is around the corner. So we have to be mindful that there are a lot of things at play here, right? And as owners and as finance providers, we all have to sit together, and then yes, but consolidation will get triggered because of this environment. Smaller owners will have to find for either a financer or a bigger ship owner to comply with the technology.
Michael, your thoughts on that front, and whether regulatory lumping all these topics of technology changes, environmental and so forth, into a regulatory, let's say, bucket, is that something that we could see sparking consolidation? And also a bit of commentary, because we've been discussing so far consolidation from a ship owner perspective. Could we see the consolidation being triggered from a ship manager perspective and see more concentration in that respect?
Well, I think anytime you have regulation, it does favor larger companies that have the bandwidth to deal with it, the time and money to research it and put in there. So, yeah, I think that is probably given a leg up to larger companies that have teams to handle it, and yeah, given that could be a future driver of consolidation.
Yeah, just to give a real world example, we have on staff one engineer who is spending full time on the work around the dual fuel LNG, rare low sulfur fuel oil switching new builds we have in Korea. So that is building a tremendous amount of know-how that is relevant to less emissions and the transition, et cetera. And we have, in addition, a full-time sustainability engineer who does nothing but work on what is happening out there and how Seaways can prepare its current fleet and any future fleet for the changing regulatory world. That's almost have-to-have stuff, but it's developing intellectual property, especially in the first case and second case, just capabilities that we have. While I mentioned earlier, because of the scale, we can still say we have one of the lowest G&As per day per ship basis. Well, that's only possible for larger companies. And so to Mike's point, I think it makes it easier for the bigger companies. It's definitely an advantage for the bigger companies.
We've seen in the past also from commercialization, let's say, of the fleet, and we've seen ship owners, forming pools and trying to get better terms from the counterparties and so forth. Is this in effect something that could be a kind of backdoor to consolidation by seeing more and more arrangements like this, or is their use kind of more limited in scope in very particular asset classes? Erol,
Sure. I'm a bit mindful speaking about other companies, but what I would say is yes and no. Clearly, pools have offered smaller owners access to strong global commercial platform operations without sort of the inbuilt costs that they would have to incur themselves. So, it's an efficient way to gain access to the commercial operation in a particular vessel class or segment. But on the other hand, you've seen, just to take an example of a large Hafnia, right, has now grown into, they've been a leader in the consolidation space in the product tanker side, and now they're a leader on, just from size, on their pool. So I think you've seen it work both ways, an impediment to consolidation and actually a boon to help the consolidation move.
Nitin, your thoughts on?
Maybe yes or no. Yes or no. Pool is a great tool for people who want regular cash flow as well, because small, especially the smaller owner. But do they actually help not doing consolidation? I'm not too sure. They do help the smaller ship owner, yes, but not the larger ones. That's at least my opinion.
And Michael, from the ship manager's perspective, shall we expect any differentiation in that market? I mean, we've seen some private equity investment in ship managers. We've seen, some of the independent managers looking to grow. Can that be a change in the approach ships are managed and affect?
Yeah, I think off the kind of the couple of reasons I mentioned off the top, whether it's just because something's inexpensive or because there's a strategic rationale or a market share play, those would be very much factors in manager, whether commercial, technical, manager consolidation. That's not an area that we at RMK spend a ton of time in, but yeah, look, I think M&A there would sort of make sense in the traditional sense of why someone would do an M&A deal.
Jeff, before I ask for some of the final remarks, I want to touch a bit on the financing side. We spoke briefly about it in earlier commentary, but does being public and being bigger help on the relationship with the lenders and having better terms on financing?
Oh, well, I think being public is a two-edged sword. There's no question that if you ask any number of senior managers in public companies, I'm sure that on a given day, they'd say, this is a pain in the neck, it's costly, and it's can be frustrating in terms of the short-term pressures you sometimes get. But to your point, clearly it's helpful in terms of credit, access to credit. I think both banks and bondholders like their creditors to have the ability to tap the equity markets. And then in terms of this panel's topic of M&A, there's no doubt it opens up another pathway to getting larger. It's no one's taking private stock in M&A, so if you have, there's a challenge of the valuation, right? You said it before, so but there's ways around that challenge. You find someone else that's trading at a similar price, or Now, we're getting closer to NAV, as I mentioned before, so, there opens up shift for shares deal as well as, even something that's almost inconceivable when you're issuing equity. So, there's no question that being public, while it is a challenge, does provide another tool for consolidation.
Michael, do you think the lenders could effectively be a factor and drive consolidation?
Yes, I think that's part of the reason we saw some consolidation, over the past decade. Right now, across this entire shipping world, we've got leverage levels that are quite low. I think we all know it's shipping at some time, hopefully not anytime too soon, but that will change. And yeah, I think you'll see lenders, help drive consolidation. But that, not to the same extent that I think the equity investors did, unless we get into some, fairly over-levered, sort of cash flow deficient situations, which hopefully we're a ways away from.
Erol, your thoughts on the financing landscape and impact on this?
Yeah, ultimately shipping remains, from the ship owning side, a heavily capital intensive industry. And so therefore, whether it's private equity or debt lenders, right, you need your partners that you work with, and those are long-term relationships that are deeply institutionalized and built up over time. ESG regulations, I think Michael on the prior panel had said it very well, and Evan, they're choosing winners and losers at the end of the day, and so you need to be quite mindful of that at your own corporate and commercial level as you look for it. And while there might be implementation, say, 10 years away, ultimately a lot of that thinking is happening now and how they're thinking about their portfolios, and so the actual decisions are much closer than you might otherwise discount from what a press release may say of when something actually goes into effect. So I think it's just being very mindful that size is important, liquidity is important, it's a capital intensive industry, you want to be on the front end of all of those changes that are coming.
And let me ask, in other sectors, private equity has invested and then consolidated businesses and created scaling opportunities by reducing costs and creating operational changes. And to a certain extent, companies do seek private equity investors for that operational excellence and knowledge. Are there areas in the shipping sector where private equity could affect that change, or is it more, participation for the asset?
Yeah, I'll jump in with one comment there. So fintech has been a very big place for private equity. It's built a lot of enterprises, and the difference, these are companies trading at material premiums to book value. In our case, premiums or discounts to NAV, and so shipping it, unfortunately, the public markets have not, or at least historically speaking, have not valued public shipping companies at a premium to NAV, so it sort of handicaps a lot of these consolidation efforts that public companies would otherwise look to use. Other asset classes, technology coming to the front of the mind when valuations are so hot in the public markets, that's a ripe opportunity to sell a portfolio, merge a portfolio, etc., because it's value accretive. So I think public markets ultimately play a very big factor in any asset class, and private equity's ability to look at both ways of entry and exit.
Nitin, going into final remarks, and if we were to be here in 5 years' time, what would you think today the landscape of the market would be? Will we have seen and witnessed more concentration?
Well, from our perspective, if I have to digress a little and of course answer in a holistic way, finance of course is a very important part, but all problems in the world have been triggered by banks from the beginning, isn't it? So it's how much you finance, how much you not finance is a decision that everybody has to take. We at GMS have a very distinct advantage. We have actually ordered brand new vessels, and of course everybody is aware of our recycling prowess, which we are the biggest cash buyers. So I can tell you from our perspective and our experience, we all have to work together to find, like I said before, find a solution to all these ESG related problems going forward. Banks have to step up, technology has to step up, we as owners have to come in line, so that because recycling a ship is not an option, extending life of a ship with the correct technology perhaps is the right answer. So that is where everybody needs to start looking at. From my perspective, yes, capital or lack thereof would trigger consolidations. Mainly, I would say any area where I think PE should actually invest, I would say technology, because that is the only answer that I see, at least in the near foreseeable future.
Thank you. Erol, prediction for 5 years from now?
I would not. I mean, predictions are hard to go by. I think you have seen a rush of capital,
Especially about the future.
not for me, Jeff. You wanna give it a try?
Are we wrapping up? Yeah.
I think so. So it's just.
I'm gonna take the last word, Mike, so.
There you go.
I'm attentive to seniority, I'm taking the last word.
Going into reverse order, so.
Yeah, we're extremely bullish. I mean, yeah, with interest rates going up, I mean, we say kind of the old economy is back, and I think you look at shipping companies across the board. Again, leverage looks good. Order books, even in the container market, are muted relative to what they would have been a decade ago in dry bulk containers. You have extremely low order books. We think this is going to become a much more yield-focused industry. And ultimately, it's really hard to go out, if you're a man in the street, it's really hard to go out and buy and operate a ship. It's really easy to invest in INSW or another public company. And so eventually that should lead to these companies trading at premiums to NAV. We think that's kind of the direction we're going for the foreseeable future. So I think we'll be in a much happier place in 5 years about the shipping capital markets and kind of the investors that are involved.
Yeah, it would be nice if we, after all this waiting, we finally got to the point where capital markets give us the kind of valuations we'd like. And I think that I agree with the panel. I think there'll be more consolidation, greater size and scale of companies, particularly public companies, therefore attracting new investors that will value us on cash flow and open up further opportunities for growth. And so I look forward to that. I just would make one comment is that implicit in all of our discussion has been consolidation is good. How do we get more of that? Well, I think we all agree consolidation can be good, but let's be clear. M&A is very risky. So there's a risk of overpaying, and there's a risk of execution blowups. What I think a takeaway for this group is that look for companies that are well advised. Thank you, Mike and others, and well funded, and do smart deals that aren't overpaying. But you can't overestimate the importance of getting the integration done afterwards. We learned that last year. Beyond what CEO and CFO can do, there's an army of people that are required to take on board a company where you're consolidation, where you're doubling the size of the company, and it's easy to screw up. I feel like we developed a lot of capabilities, a real skill set there that's beneficial. But let's be, I think that's the takeaway: is look for companies if you're an investor that have developed capabilities. We're not the only ones. Proud that we got there, but it's really important.
And to hire the right lawyers. So
I said well advised. I didn't just like I started saying.
thank you very much. Thank you.